Inflation is a fundamental economic concept that impacts everything from the price of groceries to the value of investments. Understanding inflation and its effects on your money is crucial for effective financial planning and decision-making. Let's dive into what inflation is, how it works, and its impact on your finances. Understanding inflation. Definition of inflation. Inflation refers to the general increase in prices of goods and services over time. As inflation rises, each unit of currency buys fewer goods and services, leading to a decrease in the purchasing power of money. Measuring inflation. Inflation is commonly measured using various indices, with the Consumer Price Index, CPI, being one of the most widely used. The CPI tracks changes in the prices of a basket of goods and services, providing a measure of how the cost of living is changing. Types of inflation. Demand pull inflation occurs when the demand for goods and services exceeds their supply, driving prices up. This type of inflation is often associated with a strong economy and high consumer spending. Cost push inflation results from an increase in the cost of production, such as higher wages or raw material prices. Businesses pass these increased costs on to consumers in the form of higher prices. Built-in inflation, also known as wage price inflation, this occurs when businesses raise prices to cover higher wage costs, and workers demand higher wages to keep up with rising prices, creating a cycle of inflation. How inflation affects your money purchasing power. Inflation erodes the purchasing power of your money. For example, if the inflation rate is 3%, a dollar today will only have the purchasing power of 97 cents a year from now. This means that the same amount of money will buy fewer goods and services in the future. Savings and investments. Inflation can impact the real value of your savings and investments. If your savings account earns 1% interest while inflation is 3%, your real return is negative, as the purchasing power of your savings decreases. Similarly, fixed income investments, such as bonds, may lose value if inflation outpaces their returns. Cost of living. Inflation affects your daily expenses, including food, housing, and transportation costs. As prices rise, your cost of living increases, potentially straining your budget and reducing your standard of living if your income doesn't keep pace with inflation. Wage adjustments. In some cases, employers may adjust wages to keep up with inflation, but this is not always guaranteed. If your wages don't increase at the same rate as inflation, you may experience a decline in your real income and purchasing power. Strategies to manage inflation. Invest in assets that outpace inflation. To protect against inflation, consider investing in assets that tend to grow in value over time, such as stocks, real estate, or inflation-protected securities like Treasury inflation-protected securities, TIPS. These investments can help preserve and potentially increase your purchasing power. Diversify your investment portfolio. Diversification can help mitigate the impact of inflation on your investments. By spreading your investments across various asset classes, you reduce the risk of significant losses and improve your chances of achieving positive returns. Adjust your budget and savings. Regularly review and adjust your budget to account for rising costs. Increase your savings contributions to offset the impact of inflation on your future purchasing power. Setting aside funds in accounts that offer higher returns can also help maintain the value of your savings. Consider inflation-linked income streams if possible. Seek income sources that adjust with inflation, such as Social Security benefits, pensions with cost of living adjustments, or inflation-linked bonds. These can provide additional financial stability and purchasing power over time. Inflation and economic policy. Central bank actions. Central banks, such as the Federal Reserve in the US, play a crucial role in managing inflation through monetary policy. By adjusting interest rates and implementing policies to control the money supply, central banks aim to maintain stable inflation rates and support economic growth. Government fiscal policy. Governments may use fiscal policy measures, such as adjusting taxes and public spending, to influence inflation. Policies that stimulate economic growth can contribute to higher inflation, while measures to control spending can help keep inflation in check. The future of inflation. Inflation is a dynamic economic phenomenon influenced by a range of factors, including economic growth, monetary policy, and global events. Staying informed about inflation trends and understanding its impact on your finances can help you make more informed financial decisions and plan for the future. The impact of inflation on retirement planning. Retirement planning is a critical aspect of financial management, and understanding how inflation affects your retirement savings is essential for ensuring a comfortable and secure retirement. Inflation can significantly impact your long-term financial goals, so it's important to incorporate strategies that account for rising costs over time. Here's how inflation can influence your retirement plans and steps you can take to prepare effectively. The effect of inflation on retirement savings. Erosion of purchasing power. As inflation increases, the purchasing power of your retirement savings decreases. This means that the same amount of money will buy fewer goods and services in the future. For example, if you plan to retire with $1 million, but inflation averages 3% annually, the real value of that $1 million will be significantly reduced over the years. Increased living costs. During retirement, you will continue to face rising costs for essentials such as healthcare, housing, and everyday expenses. If your retirement income does not keep pace with inflation, you may find it challenging to maintain your standard of living. Longevity risk. Advances in healthcare and increased life expectancy mean that you may spend more years in retirement than initially planned. Inflation can exacerbate this risk, as the cost of living will continue to rise throughout your retirement years, potentially depleting your savings faster than anticipated. Strategies for inflation-proofing your retirement. Invest in growth assets. To counteract the effects of inflation, invest in assets that have the potential for long-term growth, such as equities and real estate. Stocks, for example, have historically outpaced inflation over the long term, providing growth potential that can help preserve your purchasing power. Consider inflation-protected securities. Treasury inflation-protected securities, TIPS, are government bonds specifically designed to protect against inflation. TIPS adjust their principal value with changes in the Consumer Price Index, CPI, ensuring that your investment keeps pace with inflation. Diversify your income streams. Diversify your sources of retirement income to include a mix of fixed income investments, dividends, and potentially inflation-linked sources. Having a varied income portfolio can help you manage the impact of inflation and provide financial stability. Plan for healthcare costs. Healthcare expenses tend to rise faster than general inflation. Incorporate a healthcare savings strategy into your retirement plan, such as contributing to a health savings account, HSA, or investing in a long-term care insurance policy, to help manage these costs. Adjust your spending habits. Be prepared to adjust your spending habits based on changing economic conditions. Monitoring your expenses and making adjustments as needed can help you manage your budget effectively and stay on track with your retirement goals. Case studies of successful inflation management. Case Study 1, The Importance of Diversification. John and Sarah, a retired couple, invested their savings in a diversified portfolio that included a mix of stocks, bonds, and real estate. By incorporating inflation-protected securities and growth assets, they were able to maintain their standard of living despite rising costs and ensure that their savings lasted throughout their retirement. Case Study 2, Healthcare Planning. Maria, a retiree, recognized the potential for high healthcare costs and started contributing to her HSA while she was still working. This proactive approach allowed her to build a significant healthcare fund that helped cover her medical expenses during retirement, alleviating the financial impact of rising healthcare costs. Retirement planning tools and resources. Retirement calculators. Use retirement calculators to estimate your future financial needs and determine how inflation may affect your retirement savings. These tools can help you project your required savings and adjust your investment strategy accordingly. Financial advisors. Consult with a financial advisor who can provide personalized advice on managing inflation risk and planning for retirement. An advisor can help you develop a comprehensive retirement plan that considers inflation and other financial factors. Retirement planning guides. Explore retirement planning guides and resources that offer insights into managing inflation and other retirement challenges. These guides can provide valuable information on strategies and best practices for achieving a secure retirement. Inflation is a key consideration in retirement planning, and understanding its impact on your savings and expenses is crucial for a successful retirement. By incorporating strategies to mitigate inflation risk, diversifying your investments, and planning for rising costs, you can better prepare for a comfortable and financially secure retirement. The role of inflation in investment strategies. Inflation plays a significant role in shaping investment strategies. It influences how investors approach their portfolios, select assets, and manage risk. Understanding the relationship between inflation and investments is crucial for making informed decisions that can help preserve and grow your wealth over time. Here's how inflation impacts investment strategies and what you can do to adjust your approach. How inflation affects investments. Impact on fixed income investments. Fixed income investments, such as bonds and savings accounts, are directly affected by inflation. When inflation rises, the real value of fixed payments decreases. For example, if you hold a bond with a fixed interest rate of 2% but inflation is 3%, your real return is negative. This erosion of purchasing power can make fixed income investments less attractive during periods of high inflation. Stock market performance. Stocks generally offer a hedge against inflation because companies can adjust their prices to keep pace with rising costs. However, the relationship between inflation and stock market performance is complex. High inflation can lead to increased costs for businesses, potentially impacting profitability and stock prices. Conversely, moderate inflation can be beneficial if it signals a growing economy. Real assets and commodities. Real assets like real estate and commodities often perform well during inflationary periods. These assets tend to increase in value as prices rise, providing a hedge against inflation. Real estate, for example, can offer rental income and property appreciation that outpaces inflation. Inflation-protected securities. Treasury inflation-protected securities, TIPS, are specifically designed to guard against inflation. The principal value of TIPS increases with inflation and decreases with deflation, ensuring that your investment keeps pace with changes in the Consumer Price Index, CPI. Strategies for adjusting your investment portfolio. Diversify across asset classes. Diversification is a key strategy for managing inflation risk. By spreading your investments across different asset classes, including stocks, bonds, real estate, and commodities, you can reduce the impact of inflation on your overall portfolio. Each asset class responds differently to inflation, providing a balanced approach to managing risk. Focus on growth investments. Allocate a portion of your portfolio to growth investments that have the potential to outpace inflation. Stocks, especially those of companies with strong pricing power and growth potential, can offer higher returns that help preserve purchasing power over time. Consider inflation-protected bonds. Incorporate inflation-protected bonds, such as TIPS, into your investment strategy. These bonds offer protection against inflation by adjusting their principal value with changes in the CPI, providing a steady real return. Evaluate real assets. Invest in real assets like real estate or commodities that historically perform well during inflationary periods. These assets can offer both income and appreciation potential, helping to counteract the effects of rising prices. Regularly rebalance your portfolio. Inflation and economic conditions change over time, so it's important to regularly review and rebalance your portfolio. Adjust your asset allocation to ensure that your investments remain aligned with your financial goals and risk tolerance. Case studies of effective investment strategies. Case Study 1, Inflation-Proof Portfolio. Lisa, an investor concerned about inflation, diversified her portfolio to include a mix of stocks, real estate, and TIPS. This strategy allowed her to benefit from growth assets and inflation-protected securities, preserving her purchasing power and achieving strong long-term returns. Case Study 2, Real Estate Investment. John, who anticipated rising inflation, invested in rental properties. The rental income from these properties increased with inflation, and the value of the properties appreciated over time, providing a hedge against rising costs. Tools and resources for managing inflation in investments. Investment analysis tools. Use investment analysis tools to evaluate how different assets perform under various inflation scenarios. These tools can help you make informed decisions about asset allocation and portfolio adjustments. Financial advisors. Consult with a financial advisor to develop an investment strategy that addresses inflation risk. An advisor can provide personalized recommendations and help you navigate market conditions. Investment research and reports. Stay informed about inflation trends and their impact on investments through research reports and market analysis. Keeping up with economic developments can help you make timely adjustments to your investment strategy. Inflation is a critical factor in investment planning, influencing how you allocate your assets and manage risk. By diversifying your portfolio, focusing on growth investments, and incorporating inflation-protected securities, you can better navigate the challenges posed by inflation and work toward achieving your financial goals. If you found these investment insights valuable, be sure to subscribe to the channel and like this video to stay updated on the latest financial strategies and tips.